this video, we'll take a closer look at a single borrower, Eureka Fossil Ventures, and walk through how ONCI gives you a clear, forward-looking view of borrower risk all in one place. This page is designed to give credit teams the ability to dive deeper into the borrower to uncover the underlying factors that are driving the borrower health. Let's start at the top. At a glance, we see key reference details: total exposure, internal risk rating, industry, and assigned relationship manager. This sets the context. What kind of borrower is this? How material are they to our book, and who owns the relationship? We can also see if any alerts have been triggered. In this case, there are none, but as we saw in episode 1, those will be visible here if activated by deteriorating metrics or thresholds. Next is one of the most powerful tools on the page, ONCI's key credit metrics benchmarked against peers. Here we can see how Eureka compares on DSCR, leverage, margins, and liquidity, not just in isolation, but relative to other borrowers in the same sector. For example, their DSCR is just 0.4, and that's significantly worse than peers both in your book and the broader market. That's an early signal of stress. Hovering over any metric shows how this changes over time, helping you understand whether this borrower is an outlier or part of a broader trend. Moving down, we see a quarterly cash flow forecast, including revenue, EBITDA, interest expense, and projected cash surplus or shortfall. This is forward-looking, built from the borrower's actuals and ONCI's sector-level drivers, combined with macroeconomic scenarios applied directly to credit metrics like DSCR and leverage. That's what makes these forecasts uniquely credit-specific and uniquely ONCI. In this case, you can see a deteriorating trend in cash available after debt service and a predicted shortfall after discretionary spend, a signal that warrants deeper review or escalation. ONCI synthesizes all of this data into a simple, transparent risk level. This is a configurable score, allowing you to identify the overall health of a borrower in the last 12 months or next 12 months at a glance. Each component, DSCR, leverage, margins, liquidity, is weighted and scored so you can see what's driving the risk classification. In this case, every metric except liquidity is contributing to a high risk rating. This helps triage quickly. Is the borrower flagged because of systemic margin pressure or a specific liquidity crunch? Below you'll find traditional financial ratios, a full income statement, balance sheet, and cash flow history. This is here for deeper analysis or audit purposes. Finally, ONCI gives you industry context, including margin pressures, regulatory risks, and structural trends. This presents a clear view of the underlying industry drivers, insights your frontline can use to guide smarter, more informed conversations with customers. This helps you interpret borrower performance within a broader narrative, so you're not just saying that margins are tight, but why that might be happening in their industry. This page gives credit teams everything they need to assess borrower risk clearly: actuals, forecasts, benchmarks, and business context, all in one place. In the next episode, we'll look at how alerts are configured and how scenario-based early warnings can help you intervene sooner.